Monday, April 27th, 2026, 8:23 p.m. Eastern. It is Monday night. Most silver investors are winding down, checking their phones one last time. Maybe reviewing what happened in today's session, where silver whipsawed from below $76 on Trump's envoy cancellation to back above $76 on Iran's new formal proposal. You are thinking the real action starts Wednesday when Powell speaks. You are wrong. The real action starts in 5 hours and 37 minutes when the Bank of Japan releases its monetary policy decision at 2 a.m. Eastern Time. And the press conference that follows at 2:30 a.m. could send silver $5 higher or $4 lower before a single American retail investor opens their eyes Tuesday morning. And the mechanism by which a Japanese central bank decision moves silver prices in New York is one of the least understood and most important relationships in the entire precious metals market. I'm going to spend the next 20 minutes explaining it completely so that when you wake up Tuesday morning and see silver at a number that surprises you, you will understand exactly why it happened, who profited from it, and whether the move is sustainable or whether it reverses immediately at the New York Open. Let me start with the Japanese yen carry trade, because this is the mechanism that connects a central bank in Tokyo to a silver price in New York, and almost nobody in the silver community explains it correctly. The carry trade is one of the most profitable and most widespread strategies in global finance. Here is how it works. Japan has maintained near zero interest rates for most of the last 3 decades. As recently as 2023, the Bank of Japan's policy rate was negative 0.1%. Today it is 0.75%, which is still extraordinarily low compared to the United States federal funds rate of 3.5%. The difference between 3.5% and 0.75% is 2.75 percentage points. That spread is the carry trade profit. Institutional investors borrow yen at 0.75%, convert the yen to dollars, and invest those dollars in U.S. Treasury bonds earning 4.27%. The annual profit is 3.52%, with essentially zero risk as long as the yen stays stable. When you scale that trade to billions of dollars, the profits are extraordinary. Here is the critical number that puts tonight's BoJ decision in context. The estimated size of the global yen carry trade is between $4 trillion and $6 trillion, according to Bank for International Settlements data. That means $4 to $6 trillion of institutional money is borrowed yen, converted to dollars, and invested in dollar-denominated assets. Those positions are profitable as long as 2 conditions hold. Condition 1, the interest rate differential between the US and Japan stays wide. Condition 2, the yen does not strengthen significantly against the dollar. If the Bank of Japan tonight signals that it is preparing to raise rates further, either by hiking from 0.75% to 0.85% as a surprise, or by using hawkish language that markets interpret as signaling a near-term hike, Condition 1 deteriorates. The carry trade spread narrows. Institutions that were earning 3.52% annually now earn less. They close carry trade positions. Closing a carry trade means selling dollar assets and buying yen to repay the original yen loan. When $4 to $6 trillion in carry trades unwinds even partially, the yen surges and the dollar plunges. And when the dollar plunges, COMEX silver, which is priced in dollars, rises because each dollar buys less silver. A 1% dollar decline typically moves silver 2% to 3% in the opposite direction. A 2% dollar decline moves silver 4% to 6%. The leverage in this relationship is significant. Now, let me give you the specific BoJ context data for tonight's decision, because understanding the data Ueda is looking at tells you what he is most likely to say. Japan's core CPI, which excludes fresh food, came in at 3.2% in March, above the BoJ's 2% target. Services inflation in Japan, which measures price increases in the domestic services sector and is considered the clearest signal of embedded inflation, hit 2.8% in March. That is important because services inflation is driven by domestic wage and productivity dynamics, not imported energy costs. It means Japan's inflation is not just an imported energy story. It is becoming domestically embedded. Wage growth in Japan's annual spring salary negotiations, which concluded in March, produced the highest wage increases in 30 years, averaging 5.8% across major companies. When wages grow at 5.8% and services inflation is at 2.8%, the Bank of Japan faces exactly the wage price dynamics that made 1970s inflation in Western economies so persistent. Those dynamics argue for tightening. On the other side of Ueda's dataset is Japan's GDP growth. Q4 2025 GDP came in at 0.7% annualized, a significant slowdown. January and February 2026 industrial production data showed contraction as the Hormuz energy shock hit Japanese manufacturers through higher input costs. Retail sales in Japan fell 1.1% in February, the largest monthly decline since COVID. Consumer confidence in Japan, measured by the Cabinet Office Index, dropped to its lowest level since 2020. All of that data argues for easing or, at minimum, continued accommodation. Ueda is balancing the strongest wage growth in 30 years and above-target inflation against falling GDP, contracting industrial production, and deteriorating consumer confidence. The decision he makes tonight is not about economics alone. It is about communication. And the words he chooses at 2:30 a.m. are worth more than any rate change. Here is what the options market is telling you about tonight's expected move. Currency options on USDJPY, the dollar-yen exchange rate, are currently pricing an implied move of approximately 0.8% to 1.2% following the BoJ decision and press conference. That means the options market expects the yen to move 0.8% to 1.2% against the dollar in either direction as a reaction to tonight's announcement. Translate that yen move to silver through the dollar correlation. A 1% dollar decline typically produces a 1.8% to 2.5% silver move. A 1.2% dollar decline produces a 2.2% to 3% silver move. At $76 silver, a 2.5% move is $1.90. A 3% move is $2.28. At the extreme end, if the BoJ surprises with a rate hike that the options market has not fully priced, the implied move expands dramatically. A surprise hike of 10 to 25 basis points could produce a 2% to 3% yen surge overnight, which translates to a 4% to 6% silver move. At $76, a 6% silver move is $4.56 to the upside. That is the $5 gap scenario I referenced in the title. Now, let me give you the most important precedent that proves this is not speculation. On July 31st, 2024, the Bank of Japan raised its policy rate from 0.1% to 0.25%. The hike surprised markets because consensus expected a hold. The yen rallied 3.5% against the dollar in the following 48 hours. The dollar index fell from 104.5 to 101.18, a 2.6% decline. Silver, which had been trading at $28.50 on July 30th before the BoJ decision, traded at $29.90 by August 2nd, a $1.40 gain or 4.9% increase. That move happened almost entirely in the overnight sessions, while U.S. retail investors were sleeping. By the time the New York session opened on August 1st, silver had already moved $1.20 above the July 30th close. The retail investor who woke up August 1st looking to buy silver had to chase a move that was already 85% complete. Tonight's setup has comparable characteristics to July 2024, and in some ways the stakes are higher, because the yen carry trade is larger, the interest rate differential is wider, and the geopolitical context creates additional dollar vulnerability. Here is the Iran connection to tonight's BoJ decision that nobody has articulated yet. Iran submitted a new formal proposal today, Monday, via Pakistani mediators calling for a sequenced approach. Ceasefire extension first, nuclear negotiations second once the blockade is lifted. Trump has not responded publicly, but Trump reportedly told advisors last week he is willing to end the confrontation even without full Hormuz restoration. Here is the connection. Japan imports 90% of its energy. Approximately 12% of Japan's pre-war oil imports came from Persian Gulf nations, whose exports are constrained by the Hormuz blockade. Japan's energy import costs have surged since February 28th, when the war began. The BoJ's economic models are directly impacted by the oil price trajectory. If Governor Ueda believes tonight that the Iran proposal represents genuine progress toward a resolution that would lower energy prices, he has less urgency to use hawkish language to combat imported energy inflation. He can afford to be more balanced. But if he believes the Iran proposal is diplomatic theater and that oil will stay above $100 for the next 6 months, which BIMCO's mine-clearing estimate of up to 6 months supports, then he needs to acknowledge that the energy inflation problem is structural, not temporary, and that the BoJ's policy response must be calibrated accordingly. That calibration toward acknowledging structural inflation is inherently hawkish and is inherently yen positive and silver positive. Let me now walk you through the exact sequence of tonight's events by Eastern Time so you know what to watch for at each moment. At 2:00 a.m. Eastern, the Bank of Japan releases its policy statement. The statement will be a brief document in Japanese that is translated within minutes by Reuters, Bloomberg, and Nikkei. The key data points in the statement are the vote count on the rate decision, the economic assessment language, comparing current conditions to the prior meeting's assessment, and the inflation outlook language. If the vote was unanimous to hold, that is neutral. If there were dissenting votes in favor of a hike, that is hawkish and yen positive. The economic assessment language matters because upgrades signal confidence in recovery, supporting tighter policy, while downgrades signal concern, supporting accommodation. At 2:30 a.m. Eastern, Governor Ueda begins his press conference. The first statement he reads is the prepared opening remarks. The next 45 minutes are questions from reporters. The most silver-relevant questions are typically asked by Reuters, Bloomberg, and Nikkei journalists and focus on three topics. First, when does the BoJ expect to achieve its 2% inflation target sustainably? A longer timeline to achieve the target signals more accommodation. A shorter timeline signals readiness to tighten. Second, how is the BoJ assessing the impact of the Iran war's energy shock on Japan's inflation and growth outlook? A characterization of the shock as temporary signals accommodation. A characterization as persistent or structural signals readiness to tighten. Third, what conditions would prompt the BoJ to raise rates at the June or July meeting? If Ueda names specific conditions that are close to being met, the next hike timeline moves forward and the yen rallies immediately. Between 2:30 a.m. and 4 a.m. Eastern, the yen carry trade response is the dominant market force. Algorithmic trading systems at major banks run continuous monitoring of BoJ language using natural language processing. Within seconds of Ueda's key statements, algorithms are executing USDJPY trades in the hundreds of millions. Human traders at Tokyo desks, then Singapore desks, then London desks refine those initial algorithmic positions as they read the full press conference transcript. By 4 hours a.m. Eastern, the yen's reaction to the BoJ decision is approximately 70% priced. The remaining 30% is priced in as European markets open at 4 a.m. to 4:30 a.m. Eastern, and as additional institutional analysis of Ueda's language reaches trading desks. Between 6 a.m. and 8:30 a.m. Eastern, silver's overnight move is fully established. This is when the COMEX silver front month contract opens for pre-market electronic trading in the U.S. The price you see at 7 a.m. on your phone or trading platform reflects the full overnight reaction to the BoJ decision, plus any additional Iran diplomatic developments that occurred while you were sleeping. At 8:30 a.m. Eastern, if no major U.S. economic data releases, the pre-market silver price begins to stabilize as U.S.-based traders begin their sessions. If the BoJ was hawkish and silver gapped higher overnight, U.S. traders will face the decision of whether to buy into the strength or wait for a pullback. Typically, overnight gap moves driven by BoJ decisions see 20% to 40% retracement in the first 2 hours of the U.S. session, as traders who held long positions overnight take partial profits. Here is the additional Tuesday data that layers on top of the BoJ effect. At 10 a.m. Eastern Tuesday, the Conference Board Consumer Confidence Index releases. The University of Michigan confirmed at 47.6, an all-time record low. The Conference Board's prior reading was 92.9. If the April Conference Board reading confirms the Michigan collapse with a sub-85 print, two simultaneous confidence surveys confirming historic consumer pessimism create an undeniable signal that the U.S. economy is experiencing a demand shock simultaneous with an inflation shock. That combination is the textbook stagflation indicator. And stagflation confirmation in two separate surveys on the same Tuesday morning that comes 24 hours before Powell's last press conference is the news framework that forces Powell to address it directly Wednesday. Here is the $2.5 billion insider trading context that reframes everything happening tonight. Wikipedia's economic impact documentation confirmed 3 suspicious oil trading series totaling approximately $2.5 billion that were placed with precise timing before each major diplomatic announcement in this conflict. $950 million was placed betting on falling oil the day before Trump announced the April 8th ceasefire. $750 million in Brent futures was sold exactly 20 minutes before Iran's foreign minister announced Hormuz was open during the ceasefire. If those trades were made with advanced knowledge of diplomatic developments, then every major silver price move of the last 8 weeks has been preceded by informed institutional positioning. Tonight's BoJ decision happens while Iran's proposal is being analyzed in Washington and while Araghchi is in Moscow coordinating with Russia on Iran's negotiating position. If diplomatic developments are occurring simultaneously with the BoJ decision, the entities with advanced knowledge of those developments are already positioned. The silver price movement tonight is not random market behavior. It is the result of layered institutional positioning by entities with more information than you have. Here is the specific COMEX delivery context that adds urgency to tonight's BoJ decision. May First Notice Day activated Monday. The CME Group published the first delivery notice count this afternoon, Monday at approximately 3:30 p.m. Eastern. That count revealed how many May contract holders stood for delivery on day one. The coverage ratio remains at 13.2%, meaning 76.88 million ounces of registered physical silverbacks, 235.2 million ounces of paper claims. In January 2026, 33.45 million ounces were withdrawn in 1 week, representing 26% of registered inventory. If tonight's BoJ decision causes a sharp silver rally, it changes the delivery economics for May contracts. At $76 silver, the arbitrage between COMEX paper and Shanghai physical at $90 is $14 per ounce. If the BoJ sends silver to $80 overnight, the arbitrage narrows to $10 per ounce. Fewer institutions find the arbitrage profitable enough to stand for delivery. Delivery pressure eases. The COMEX registered vault stress decreases. Paradoxically, a bullish overnight move driven by the BoJ could actually reduce May delivery stress by narrowing the Shanghai arbitrage spread that was incentivizing physical delivery. The 5 scenarios for Tuesday morning silver and what they mean for your positioning are these. 1. Silver opens Tuesday at $80 to $82, up $4 to $6 from Monday's close. This means the BoJ was significantly hawkish or surprised with a hike. Hold through Wednesday's FOMC. Powell's last press conference will likely add another $2 to $4 if he signals any dovish nuance. 2. Silver opens Tuesday at $78 to $80, up $2 to $4. The BoJ was neutral to slightly hawkish as expected. Today is a positioning day. Buy consumer confidence weakness at 10 a.m. if it confirms Michigan's all-time low. Hold through Wednesday. 3. Silver opens Tuesday at $76 to 70 centavon, up $0 to $1. The BoJ was exactly as expected, with no surprises. Today trades on Iran proposal, updates, and COMEX delivery data. Wednesday is the event. 4. Silver opens Tuesday at $74 to $76, down $0 to $2. The BoJ was surprisingly dovish. This is a buying opportunity if you believe Wednesday's Powell press conference will be dovish. A dovish BoJ does not change the structural silver thesis. 5. Silver opens Tuesday at $71 to $73, down $3 to $5. The BoJ made a significant dovish surprise or announced unconventional accommodation. This creates acute stress on the 70 triple tested floor. Watch whether $70 holds. If it does, the structural bull is intact. If it breaks, the technical picture deteriorates significantly. You have 5 hours and 37 minutes before this all begins. Your physical silver stack requires no decision tonight. Your paper silver exposure requires you to understand the 5 scenarios I just outlined and to have defined your response to each one before you go to sleep. Not after you wake up and see a number on your screen. Before. The traders who profit from overnight central bank decisions are not smarter than you. They are simply prepared for more scenarios than you. They have buy orders set at $71 to $72 if silver drops. They have profit-taking orders set at $80 to $82 if silver rallies. They have stop losses defined, and they went to sleep with a plan. Tonight's Bank of Japan decision is one of the 5 most important single events for silver pricing in all of 2026. The other 4 are Wednesday's FOMC, Thursday's GDP and core PCE, and Friday's non-farm payrolls. All 5 arrive in 96 hours. Tonight is the first one. Go to sleep with a plan, wake up with a position, and understand that by Tuesday morning the move will already be done, and the question is only whether you are on the right side of it.